TGIF, everybody. Thank God I found ForexAnalytix. We have NFP. We have Victor Sperando. What an exciting way to cap off the week. Don't you think, hi, Alexander? Sinatra, my team members. So, Ryan?
Morning, Dale.
We got the reversal week in EG.
Yeah.
Okay, I yesterday I didn't know, really exploded. I held these. I think this is just the beginning. And even if the dollar, which is really, put in a terrible week, and kudos to you seeing it Monday. I don't know if you were looking for this much this fast. What an ugly week in the dollar. And the yen still looks okay. So what do you think going in? We just throw away our charts. Looks like we have, maybe some type of failure here in the S&Ps rallying back to resistance. Yesterday they got to it. So looks like if we take out today's lows, I still think that the hedge fund guys, or that lady that was so relieved a week ago last Monday, may need some, I don't know, Tums or something else in case there's indigestion down here.
What do you think this is? Because to me, the stock market just looks like it's playing between all the earnings coming out. Like you said yesterday, some big swings. The liquidity is looking like it's a problem when you get these big swings. Maybe we just got to see out the earnings, and then we'll get down to where it wants to go next.
Yes,
but for the euro, Stell's been saying it. I've been saying it. Just waiting for this change in tone from the ECB. It's been coming. And here we are. And, we've broken out the short-term range. And now we need to see what the market wants to do with it. If it busts 115, that's another signal that we're changing around here.
Yeah, that's a big deal. Right.
Euro sterling, it could get much closer to my level, that 2019-2020 double bottom. Within 6 pips or whatever.
It was right. It was 6 pips away from where you were looking.
Yeah, if you go on the weekly, you see that 2019-2020 double bottom. That's been one of my levels I've been looking at.
Nice.
I didn't make use of it though when we got down there, because I thought we got the initial move, and I thought the Bank of England presser Bailey will cement that move down, and we might see it further. That didn't happen, and it reversed, and then the ECB came in and walloped. So I cut out 99% of my long-term short there at 83.67, I think it was.
Okay.
And that's that trade over. I've got a little bit on just in case this is some sort of fake bounce, but I don't think it is. If that gets above 85, I'll collapse it and then start looking at longs. And I'm already long euro dollar. As we spoke about beginning of the year, potential trade for the year. Bit of a chase, 113.80. I just hit the button. I couldn't stand to see it keep running higher, so I just jumped in. And Euro Swiss as well, and we'll see where it goes.
Yeah, so I mean, this is a big change if it is the bottom, and certainly a great week in the euro. And because of what EG's doing, anytime you think the dollar is going to bounce, here's your preferred short now. Okay, so it hasn't been, and I've been trying it because I've been thinking for a while with this grinding action that we had in EG that this was going to happen. So now, pound doesn't look as great as the euro. In fact, I still think the pound could challenge the lows. We have something like this, and I would say that 2 hikes in a row, and that it's not up here, and that right now this just looks like a retrace. I think can make it vulnerable for another decline. And if it takes out this low, we're going to 130. So, a story of how things have changed in a week, where the pound was the one everyone loved, and
in a day, in a half hour, if you like, that's how quickly
that's how it is.
Change.
I can't tell you how many times in my career, Ryan, that I've stuck with something and maybe I got stopped out, and it doesn't mean that I go, I got burned in EG and I'm not going to trade it anymore, and I'll just keep at it. And then that one time I go, I'll just watch it for a while. You could count on it turning when you let your guard down and you're not there.
It's exactly the same with my euro sterling short. We've been talking about it for months since I've been here, waiting for this break. And then in the space of half hour, an hour, I've got to get out. I've got to look at flipping long and, nearly 2 years of trading. I've got to make a decision in minutes, that's trading for you.
Yeah. And I mean, what a difference the weekly looks in the yen compared to the dollar, so, and I looked at yields and you know what, there's no reason to think that yields are going to drop here yet.
No,
I mean,
we need to
go ahead.
Mate. No,
the formation isn't bearish. It's, just some consolidation between 170 and 190. There's a weekly. It's done nothing wrong.
No, yet. But we got to take out those highs, haven't we? If we don't take out those highs, it's all about what can it do. If it can't take out the highs, then you got to think how high can dollar yen really go, unless there's some real fundamental change in in Japan or in rates. But we know where the Fed are at. We can't price anything more at the moment. It's all priced in. So if we can't break those highs, then we got to question: are we just going to go sideways, or are we going to see a real shove lower?
Well, if we get a weak number, that should be the catalyst. If it takes it down, the surprise is it's not as weak as the market's expecting, and we break out this little triangle. Yeah. And the measured move just from a range is 20, call it 20 bips above this high, and that gives you 205. Yeah. So I still think that's going to happen, and 117 yen is going to happen.
We couldn't be more in the middle of that range, could we, in those years? This year.
And S&Ps, and especially NASDAQ, with what happened to Punim, which is a Yiddish word for face, Facebook. There used to be a nightclub on Rush Street called Faces, and we called it Punim.
I had a nightclub close to me called Faces,
Really? And look, and we have Face here. So
we had one in Canary Wharf called Secrets, but that was a different kind of club.
Yeah, we know. I know about that one as well.
You've been there, K-Man,
huh? Don't go there. K-Man has no secrets.
Yeah, you'd love that one, Dale.
Very popular with the bankers.
Rod Stewart. Yeah. Okay.
Good morning, guys.
So how you doing, Sal?
I'm very good, and from one day to the next, what were we talking about yesterday at this hour? We were saying that there's a risk that the ECB is going to change its tone because of inflation, and a few minutes later they did. So look at what the euro is doing, and well done, Ryan, for calling that. I'm not going to congratulate myself, so I'm going to congratulate yourself.
Well, and I'll congratulate you.
I still think. The euro is going to see strength. Now, the question is 94.50 in the Dixie. That's the big one. If we drop below there...
that was a breakout level, 94.50.
I think...
Right here.
Yeah, if we break below there, then, oh my God, I don't know where it's going. But I think it's probably going to be a nice counter trend long if you want to play it. But, tight stops and all that, the usual stuff applies. But... what have we got? We've got two more central banks which are hawkish. Okay, the Fed is very hawkish. The Bank of England is hawkish as well. They talked about the 50, almost did the 50 yesterday. And the ECB is turning hawkish. The ECB is always last, but they're turning. So we have hawkish central banks, the major ones, except the BOJ, let's say. And we have risk assets still relatively elevated. So I still think we should be selling rallies in equities and all risk assets. I'm actually surprised today that cryptos are rallying hard as equities are being sold. I don't get it, but there must be a reason for it.
Wait. Cryptos are being they're being bought.
Bought. What did I say? I said
you
rally.
know what? I don't know. I'm half asleep here. I don't ask me, and definitely don't ask Dale because we don't know. Just kidding, Dale.
I know. I can't figure out. I mean, I don't think it's such a strong pattern. Maybe it's going to rally, but I mean, the rally we had in S&Ps compared to Bitcoin we talked about yesterday was pretty anemic, and that's before it did this. So another flag. And Aussie looks kind of weak to me. That Aussie's a prime candidate for, I think, retesting the lows with risk off unless they turn the market. Compared to the other currencies, it had kind of a mixed week. Let's see the candle. Yeah.
Wait. Are you really talking smack about my Aussie longs right now? Are you really? Are you really? And then, Ryan's also here. He's listening. By the way,
still 68.60. That's all.
Hey, listen. I actually been looking for a pullback in the Aussie, and my 2 cents was, and we can talk about this here in a second. Well, my 2 cents is that the Aussie was supposed to pull back to 70.80. So we got really close this morning. I'll show you guys the pattern that I'm looking for, and I'm still long the Aussie. So, but I'll tell you guys kind of what I've been doing the last couple of days. We'll talk about that here in a few. I'll let you guys continue on.
Okay.
Yeah.
Okay, go ahead.
So I was just going to say, I still think we remain sell the rally mode in risk assets, especially given that yields are still not retreating. They're kind of 10-year US is kind of hovering in the 180s. So as long as we're this close to 2%, which I think is going to be a big psychological level, I think risk should be sold on rallies.
Wait, speaking of yields, did you guys see the boons yesterday? I mean, it's obviously following the ECB, but man, did you see that move? Holy or
even the shats, the 2-year. I mean,
yeah. I mean, dude, so just so you guys know, the boons hit the 161% extension of the October 2021 low to the December 2021 high. So we actually hit that golden fib and bounced from it today pretty aggressively thus far. So, but that's how aggressive it's been just over the last week. Anyway, sorry, continue on about.
No, I'm looking forward to seeing that chart. And
here, I'll show you guys. Yeah, I'll show you guys what that chart looks like.
I want to know what a boond is. What's a boond?
A boond.
Whatever German guys that think you're German people are, but anyway, you can see the boond hit there, the 161% extension. Like I said, I was looking at that yesterday, and we were obviously past the 127% extension. I'm like, man, I think it's going to stretch its legs. I wrote that last night for the analysis on the boons, and we have, but you got to look at like the 10-year. I mean, realistically, if we have a strong number today, that the 10-year can break, and this will put another lift in yields. They'll push us up towards 2%. So, what are your thoughts there, Stel?
On the 10-year US.
Oh, well, you were just talking about yields in general. Yeah, go ahead.
I was saying, as long as we remain at elevated levels and you have Eurozone yields rising, I'll be very scared about going long equities, at least, maybe in the very short term, yes. But, overall, I think we should be selling rallies. Again, it's not advice. This is what I'm looking to do. But, everything points towards equities going lower. Yes, I know we've said this a few times in the past, but now I think with yields here and with the central banks getting hawkish, I think this is probably higher probability of this happening. Yeah.
Well, man, it's. I mean, I think about like the conditions, with yields around. But man, hey, what do you guys think about this euro move where we're at right now? I mean, you guys have been calling it since the beginning of the year, but look at this. I got to show you guys this before we get into all this little nitty gritty stuff. The highs of the euro overnight are near 115. I thought we'd reach for 115 last night, but whoa, dogs.
Sorry, I'm muting.
No problem. No, I was just going to say, look at that weekly candle. I mean, that is downright disgusting. If you guys are well, hopefully you're not short, but man, think about that. Like, look at that weekly candle. We've really basically nearly engulfed like months worth of consolidation, caught everybody short below 112, and here we are near 115 in a week. What do you think will happen next week, Ryan, with the euro at these levels? I mean, I figured Asia was going to take up the euro towards 115 last night as they have to reposition themselves. But, you know, here we are near 115. Do we make a move for 117 next week? What do you think?
Yeah, I think it's going to be a test today. You know, as we see time and time with prices, you know, it has a big move over a big event. We're into another big risk event with the NFP. Sometimes the market just pulls into the side, into the service station, you know, get over the hump, the risk, then we crack on again. So it's going to be interesting what the NFP is going to do. You know, is it going to be bad? If it is bad, we know why. Omicron, blah, 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 blah. It'll get brushed under the water. You may see an algo dip in the dollar and then brushed under the rug. Off we go. The problem we have is, does it bounce back next month? Well, we're not going to know till next month. So the market's going to brush this one under the carpet if it's bad. If it's good, it's going to say, yeah, great. It's not as bad as we thought. Happy days, carry on as we are. But in the context of the wider picture that we've seen, the jobs market has been solid for months and months and months. It's not going to change. It's back to the same scenario. If it's not bad, it's good. So as far as the euro dollar goes, I think we could see the push to 115 if there's no waves made by the NFP and we get over the data hump. As for next week, one thing I queried in the room talking to some of the guys is, you know, we've got this big shift in expectations, and I've been all about how markets can move massively on changing expectations. But I'm wondering now if this can really rock it. Are we going to see 120 plus? Because despite the change in tone from the ECB, we all know central banks are moving that way anyway. The general gist is that they're all going that way anyway. So it's not a shock that the ECB are starting to move. So when you don't have that shock factor, like we did with the Fed, you know, last year, the expectations are maybe not as explosive as perhaps they could be. So, yeah, if we head to 117, I wouldn't be surprised. 120 is possible. Around there, I'll be thinking, okay, let's see what the price really wants to do and whether it's going to really smash higher. And if we can't get above 119 sort of thing, then you're going to have to start asking questions. But
117 is already a big level.
Yeah, I was just going to point out, K-Man, good morning. And I was just going to say, this 117 spike low from back in March of last year, I think that's going to be the big kahuna. I mean, that's got to be, I would say this last move, that's probably about a 50% retrace, somewhere around there.
Yeah.
Pretty damn close. It's actually right spot on a 50% retracement. So of the last move, not the entire move, but yeah, I think you're right. 117 is going to be a big level, but
big key, I think.
Yeah, how do you reconcile it? Like let's say you're short the euro, and I just completed this, and I just want to talk it through. All right, you're short the euro dollar. You got short sometime yesterday, like you got short at 114. You know, you thought this little black support was going to hold, and you got short, and here you are, you know, at 114.60. And let's say you're just like, you know, you got in this trade short and you're like, okay, if it breaks above 115, I'm going to get out. But if it's, you know, as long as it stays below 115, I'm going to stay short for, you know, for a little bit. But now you're underwater 60 pips ahead of the NFP. How would you actually deal with that right now? Like for me, I'm in the camp that any US dollar strength today is probably going to be faded. So, and there's a good chance that we're not going to have US dollar strength. There's a good chance that we're going to have a weak dollar or weak data, which could put the euro theoretically, you know, above 115 post data. So what are your thoughts here? If you were stuck short, I'm just theoretically not saying
I'm not because I'm low, but
yeah, me too. I'm long euros too, but I'm just saying, like, if you're stuck short, what do you do?
I understand. But I mean, either since you've been close and it's been rejected the first time, I had actually an offer at 114.95 to take profit, and we just didn't make it up there.
That sucks. Wait. Can you stop there? So when you get to 83 and you're watching it and you didn't reach your take profit, being a longtime bank trader, what do you do at that point?
It's a small slice, Small slice. You take a small slice off, and just in case. And ahead of the NFP, the labor report, I scaled back anyway. I was long euro dollar, long euro yen, and I scaled back on both, and just keeping like a smaller in position. But if you're short, I think at this stage you just, I think, hope and pray it doesn't break 115, because then you can accelerate. What I wanted to say though about the euro, and Ryan spoke about that in the room as well, is that you can't underestimate the size of the euro block compared to anything else. It's the second block right after the dollar. And the euro has been used for so long as a funding currency because it's part of the ultra low yielders like the Swiss and the yen are. Yeah, and then the ECB starts to change tack. So we're not only talking about euro dollar here, but look at the euro crosses. They have been absolutely flying.
Well, yeah. So thanks for bringing that up. Regarding the euro crosses, I mean, you got the euro Aussie that has actually broken
euro
this.
Kiwi, you name it.
Yeah,
just you name
yeah.
it.
And for those of you that don't know, because I mentioned this, this is interesting that you bring up the euro Kiwi. I'm short. Excuse me. I'm long, and I've been long for the last couple of weeks when we broke this trend line actually here. And somebody, I was doing the webinar, or not the webinar, the show called The Trade-Off with Chris Weston this week, and on Monday. And I said, hey, Euro New Zealand longs, inverted head and shoulder pattern, because we was talking about like trading the euro. And I'm like, that's a good idea. I'm like, look, I've been long, but it's really breaking out. And somebody came back to me and said, oh no, that pattern was weeks ago. And I'm like, I don't know what that person was talking about, but this is what I'm looking at.
Anyway, if it's weeks ago, it did go higher.
It was weeks ago when it started to move. Yeah. And if you use Forex you would have known that, because we had that inverted head and shoulder pattern back on January 6th of last month. So but you got Euro New Zealand, Euro Aussie, Euro Sterling, for crying out loud.
Euro Sterling, Bailey is an absolute donut. What did you do yesterday? Jesus.
And Ryan, I know, closed out of his shorts yesterday. Very smart decision, because that was like literally 150 pips ago or something, or I don't know what it was. Euro Canadian has ripped higher, and look at the Euro Mex. Even the Euro Mex is.
That's the thing. When you change direction, when the central bank is starting to change direction in one of the big blocks, you can't ignore it. And so all those people using, dollar rand has been hanging around here. It was very easy to be short euro rand. Just rake up some pips, short euro mex. But all those trades now have and have to be put in doubt, because sooner or later they are changing tack, and if such a big block changes tack, it's going to have an impact on everything. So that only already that has an impact on the euro dollar, because you as we can see, the Aussie dollar is lower, the Kiwi dollar is lower, the dollar Canada not going too far, but it's relatively big. Cable is lower than yesterday, so all of those things are euro crosses, and that is feeding through in the euro dollar in turn.
So
I'm not sure that euro dollar as such, because Fed is effectively going to stop QE and start to raise rates. I don't know whether euro dollar, I think we could have a break of 115, maybe a fast run, because there must be long-term shorts in there up to the 117, but I'm really not sure that we can break 117 at this point.
Okay, well, you know what? And after this magnitude of a move over this week, I'm actually with you. So let me ask you guys this: we got 7 minutes till the jobs report. And by the way, DJ was saying the euro sterling was a very easy read yesterday. I agree. That probe below, and you can see we updated the ForexAnalytix. They got alerts, and everybody, if you weren't in the chat room, even the light version that costs $19 a month for ForexAnalytix, they got this update yesterday ahead of the ECB. That massive support on the weekly chart, that probe below, that was a fake out. That was as fake out as it comes. But
you can say a big thanks to Bailey, who screwed up the sterling yesterday.
Yeah, well, and who made the point yesterday? Was it you, K-Man, that made the point yesterday about every central bank has their commentary has been almost different. Opposite of their, is that you that pointed that out yesterday?
Yes.
And that's exactly what happened yesterday.
Exactly. And it happened with the ECB afterwards, which is crazy, right? I mean, it's a home run on all the central banks.
Yeah, amazing. Anyway, Yeah, and like I said, great job on Ryan. He's been trading this long-term short since like 86 pence or 90 pence or something like that.
92.
92. And look, he closed out right at support on a multi-year basis. So well done, man. I mean, that's it doesn't get much better than that. So here we are. We're 5 minutes away from the jobs report, and I'm going to give you my quick 1 minute thought, and then I'll let you guys go. So as far as the dollar goes, I actually think that today's data, it could be. I actually think it's going to be weak, but any type of dollar weakness should be faded. So if we see, like, if we, and I'm going to talk specifically with, some of these commodity currencies like the Kiwi or something like that, which I'm not short right now, but if we have, weak data, the euro, when we can, let's actually talk the euro. Let's say it's weak data, and we create some sort of, like, let's say it's some negative print that everybody goes, ooh, that's not so great. I still don't think it's going to change the Fed's their thought process. So I think whatever the Fed's going to do in March is going to happen in March, unless inflation data really starts to show some reversals over the next 2 months. But I don't think NFP is going to be a big deal. We got to watch wages today. But any spike higher, like especially like the cable, holy cow, if we get a spike higher back to like 135.70, 136, I might actually be tempted to play the dollar long. And I'm also looking against other currencies as well, which obviously people in the ForexAnalytix chat room know what that is. But what do you guys think here as far as the dollar goes?
Watch that dip in euro dollar. That'll be a key signal. If that dips really just on a knee jerk and it lasts seconds, then this is going higher. Okay, that's good analysis. I really think that the euro dollar is very limited to, it's not going to dip below 114. Matter of fact, I think we'd be lucky if we dipped to 114.25 today. That would be my gut instinct. I agree. Yeah. Okay. What do you think? I'm sorry, K-Man.
I think for dollar pairs, maybe just fade the moves. But I think the euro crosses aren't finished. So I guess there's going to be support euro dollar anywhere between 114.25, 113. What is it? 1890 or so? Or 113.60 was a break level. So anywhere between 113.60 and 114, I think is a definite buy, really short term.
Yeah, and I'm really skeptical if we get there, but let's hope we do. For those of us that want to get long again.
I just want to say one thing. You said before, what would we do? What would people do if you were long? Sorry, if you were short euro dollars here? Right. I would just cover straight away before the number.
Oh God, you can't stay short through this number, because what are you going to do? I mean, if you were short at 114, or let's just, again, going back to our scenario, you're short at 114. Let's just say the number is horrendous. I mean, what's stopping the euro from trading up towards 116 today? Yeah. I mean, theoretically, I always like to ask and I learned this a lot with the guys at the Gallos office that I traded with for so many years. They always would ask the question, like, not like why. Well, they'd ask the question like more like, why not? Why can't it happen? And kind of play that devil's advocate even more so than I would. So, if you look at after this big move, like, what's stopping the euro from hitting 116 today? I don't think it will, but like, you got to think defensively like that if you're actually trading counter trend right now, right? If you were fading the euro,
I think the Fed likes a weaker dollar.
Well, every central bank does. What were you going to say, Ryan?
I was just going to say, you've got to be objective about your positioning. You can't marry your position. You can't say, well, I'm long, that's it, I can forget about it. Always be objective. What can go wrong with your trade? Why might you be wrong? And that's what you're going to cover, because that's the part that loses your money. The other side.
All right, guys. So, and you're exactly right, Ryan. And these are the types of things we talk about in the Forex community. Here's the data flash. This comes with inside the app. So I'm going to pull over. I'm going to actually pull up two things. I'm going to actually pull up the S&Ps, and I'm going to keep the euro on. Since everybody's watching the euro, we should probably keep an eye on the euro. And we have the S&P right here just to see how it acts. I actually just closed my, let's see. Can you guys see my screen here. I don't know what happened here.
No, we just see Blake Morrow now.
Okay, how about that?
Oh, there you go.
Okay.
Yep.
Okay. I just closed my Dow shorts. I had some Dow shorts going into today, so those
Numbers.
are out.
Oh, 467. Is that it?
That's a good number.
467.
Yeah, see?
A revision
good
much higher
number.
too. Revision much higher.
So let's hope the euro dips a little bit
look,
here.
average hourly earnings 5.7% versus 5.2 expected. This is good for the dollar, right?
Well, that's what you think right now, right?
Yeah.
You think that.
But look at that. Euro dollar is down like what? 20, not even 20 pips.
I'm buying that euro
man.
right now.
Canadian report pretty bad.
There goes Aussie.
Ah, damn, I just tried to. Dude, they won't give it to me. I just bought the euro at 42. God dang it, man. It took me forever to fill that.
Horrible Canadian data as well, yeah.
Yeah, and I actually got filled on an Aussie down at 80. Well, out of the money. That sucks. Oh, no. Oh, yeah, I got filled some of the.
So some good news with this. Obviously, the wages are higher. Participation rate is higher as well. That's good news. That's affected the unemployment rate. So that's why that's stepped up a tick. We've blown the Omicron worries out the window with that print. Whether that shows next month or not, we'll wait for then. So overall, good numbers. Not the disappointment it was supposed to be. Good on the participation rate. That's people coming into the market, and that's what the Fed wants to see.
More good news. Victor Sperando's with us.
Excellent.
That is exciting.
Leave you to
All right.
Yeah, and so hey, guys, I want to say, sorry, I was just in the middle of finagling some positions and stuff. I just want to say, I got long the euro down in the low 40s. I think that little probe below that support should take us right back into the mid range. Like I said, I don't think the data that you see today. I mean, it's strong data, right? Is it going to shift the gear of anybody at the Fed right now? Like, only thing people are thinking is maybe a half a basis point in March versus 25. But who wasn't thinking that anyway?
Yeah, I think there's relief here that it wasn't crap, and I think there's a bit of extra bonus that it's actually fairly strong. So yeah, it cements what we know about the Fed. Right. See a new high in dollar yen and 1% and 2% in tens is another question.
Yeah. Okay. Yeah. And I agree with that. So, all right. Well, hey guys, I want to say thanks everybody for being here today. You know, we're here every single day. So if you just showed up for the NFP, remember we do broadcast every morning at this time, and we have for the last 5 years. So make sure you're joining us every day. I'll see you guys in the morning edge for the ForexAnalytix subscribers in about 45 minutes. Ryan, Stelios,
cheers,
Dale,
guys.
I don't know. Steve popped in here. K-Man, Ryan, Dale, Stelios, Steve, K-Man. Can I still
said
go?
those already.
Wait, Stelios, Ryan, K. All right. See you guys. Have a great Friday. TGIF.
Try decaf. Try decaf. All right, buddy. All right. So thank you, team, and welcome to F.A.C.E, Victor Sperando. How are you, Vic? Waiting to hear you. Unmute.
Okay.
There you are. Got you, Vic.
Okay, cool.
All right. So I'm going to be sharing my screen here. And it really is a great pleasure to speak to someone I followed for a long time. And many people are excited to have you here. And I appreciate you taking time to speak to our community, Vic. And, it's really an honor to talk to you. You've been an icon, and especially in the commodity complex. Used to watch you on, I think even back to the old, do you remember FNN, Vic?
Yeah.
The Financial News Network before CNBC?
Correct.
Okay.
I think that, yes, before CNBC.
Yeah. So, Vic, I've read the bio, and I like to do this. I know you've had a long and storied career. In fact, one of my heroes gives you such a great testimonial. I think it's Paul Tudor Jones here. And he talks about, that you're, here's Paul's quote about you. Why don't you tell us what you were doing before your first gig in the business and how it happened for you.
Well, started in 1966, January 2nd, actually, at Pershing and Company,
Okay.
as a very high position called a quote boy. And
Is that like a runner?
we used to, Pershing, as you know, is a broker's broker. And
Right.
in those days, orders came in over the telecom.
Right.
So we had a circle where you would take an order that was telecommed in from, say, Kansas, and you'd run over to whatever a space there was that would have that particular stock, say IBM. You would give it to the clerk. He would call it down, and Pershing was very fast. They could execute an order in minutes, and then we send it back. So it wasn't it was a great starting position. I met a guy named Milton Leeds. Most people never heard of him, but he was a day trader for Pershing. And
Okay.
It really led to me wanting to be a trader.
Okay. Yeah. I mean, how fortunate in the days where you had big communities and people were isolated from COVID, and there used to be trading floors. Were you ever a member of a major exchange? You ever try that? Yeah. Was it Comex?
Yes, virtually all of them except the New York Stock Exchange.
Okay. So, I mean, you had that experience too. I mean, where you could rub shoulders with some of the best traders in the world. Although a lot of floor traders, Vic, and you definitely made the transition, but there are a lot of floor traders that never learned how to be right in the market. All they had to do was trade the paper, right?
Right.
And a lot of guys couldn't make that transition, but you were always interested in the mechanics and what's behind the market. And, it seems like you always had a bias by the things that you wrote and shared what you were seeing ahead. So, congratulations on reinventing yourself after the floor days. So, anyway, why don't we get to what's happening today now? We've had a big weak in the dollar, possible dollar turn, and the S&P's had that big break in January. NASDAQ was even deeper. What's your take on what's happening here in the markets and the change of the regimes by central banks around the world? Are they making policy errors here, Vic?
They're always making policy errors. The question is how much. The concept of being late on thinking inflation would be as high as it is and as sustained as it is, they're now using moral suasion to talk the market down, the inflation expectations down, and that's really the policy. The policy is not raising rates according to Jamie Dimon 7 times. That is a propaganda machine there with all these banks coming in, one outbidding the other with how many rate increases they're going to be, because they want to talk this inflation rate down. In my view, tops 2 rate increases, and that's for show. That'll be a quarter each for show, if that. And we have to see what that's going to be when you come to April, because the economy is slowing down. Now, This jobs report today is 467,000. I don't have the number in front of me, but it basically, because I'm talking to you, so I don't see it on my machine. But
can you really trust these numbers anymore anyway, Vic? I mean, revisions and everything. I know markets react to them for the first half an hour, but I think you're a guy, price action's everything. And people who buy headlines today sell newspapers tomorrow.
Right. Well, if you go back 10 years in January, the non-seasonally adjusted numbers, which you don't see unless you go and look on the BLS website, is 2.7 million jobs lost.
Yeah.
That's the average of the last 10 years. There never is a positive number because everybody's letting go of the Christmas season hirings. Yeah, 467,000. So the key here is it can be any number you want because it's seasonally adjusted. They just pick a number to make it average out for the year so that it all adds up during the year. So jobs increase generally, except if you're in a recession, after January, but it just is to blend so that it's a smooth number. This number has no meaning whatsoever. I mean, that jobs number has zero meaning. So you really have to look at the other parts of the economy to get a feel of what's going to happen with Fed rate increases, and that is if the economy is slowing down, which I see things like sentiment, the ISM numbers, all these various economic releases. There's no way you're going to get more than 2 rate increases, if that.
And even so, Vic, what do you think? I bring up that the Fed could raise rates 50 times, and I'm not going on a diet, and grains to care more about weather than they care about rates. Looking at oil here, I know you were a commodity guy, Vic, and this has been nonstop since we had that negative print during COVID. How's the Fed going to control inflation if they can't get a handle on oil? And we all know that SPR release was just a token gesture, like trying to jawbone the market down. You think we're going to see 120 oil here this year?
Absolutely, before the end of March.
Wow. Are you looking for an invasion, or will it be avoided?
No, you're talking about Russia, right?
Yeah.
Yeah. No.
Okay.
No, that's propaganda. The wag the dog story to get Biden's horrible numbers to be distracting.
Okay. All right. So, unless we get a break in crude into the summer, it would be, looking pretty bad for the midterms here. As far as the S&Ps, do you think that we put in a long-term top? Are you in like Jeremy Grantham's camp that this is, the bubble of all times? I think he calls it a 3 sigma event that he's looking for. But I mean, he's been saying that for a year or so now.
Well, yes. And everybody that looks at valuations, he's an investor type. I respect him, but I am not in that camp at all, because there's so many people that are in that camp, that are in the crash camp. And I am too. But I am saying you're not going to see it coming. It's going to be a surprise event. It's not going to be something where the Fed and the banks are telling you they're going to raise rates 7 times.
Yeah. So it'll be something we're out of left field, and it won't be Fed related. It could be, how about the vaccine crash, where, there's a possible variant that evades vaccines, some type of event like that, or China.
China is more likely after the Olympics, where they make a move on Taiwan, and that it's going to be.
Do you think that's going to happen after the Olympics?
I would say 60-40, yes.
Okay. All right. So while we're distracted and looking at Russia, and then we see the beautiful opening ceremony, and I watched some of the prelims yesterday. After February 20th, I know a lot of psycho guys are looking at March as being a very critical month for a lot of things. Fed meeting there in March as well. So that would be something that's out of the purvey of the Fed, some kind of geopolitical event like that. And also, isn't China, with their zero tolerance when it comes to oil, they are the biggest consumer or second biggest consumer of oil?
They're the biggest consumer of everything.
Okay. Yeah. So So if after the Olympics, despite all of their efforts, COVID's going to spread there, and they have a zero tolerance policy that they reinstate after the Olympics, they could really shut down the whole country. And wouldn't they have an impact on the oil and other commodity markets?
Oh, absolutely. But I don't see them doing that. I mean, they care more about they don't care about climate change either. They care more about feeding the masses, which keeps their political power. Now, I do understand the Omicron problem, but it's not a death killing. It's not Ebola. You know what I mean? So I think they played it a little differently. And I think a surprising event and this is my own speculation, but it's since you're a currency shop, would be for OPEC, meaning Saudi Arabia,
Oh,
which is not.
I know where you're going.
It's not very close to the current administration, to say the least. See, what I
The
see
end of the petrodollar?
right, and using there's no other reserve currency. It'll be a basket, and it'll probably include some gold.
Okay, so I wanted to get to gold and the dollar. A lot of people, when you look at the dollar, Vic, you can interpret this, especially with the great week we had in the dollar, as this whole thing that we had during 2021 as just being a bear market rally back to here, and that the dollar decline could begin in earnest again. Do you think the Fed welcomes a weaker dollar? Does that attract foreign buyers into treasuries and makes it easier if they do go ahead and tighten, and gives them more of a window to do it?
I think that their goal with the dollar is stability. That's what it has been. That's their goal now. I don't think
not bad. They've done a pretty good job from 2014 to now. I mean, it's been in a pretty wide range, but it is, that is a huge range.
Yes, but it's basically stable. I mean, for me, currencies are rather stable trading vehicles, but neither here nor there. I'm just guessing, and I don't have a strong opinion on this.
You know what, Vic? That is that's a pearl, because people have a hard time saying, I don't know. You ever notice that on Twitter? I don't know, and I was wrong. Which the great, all the greats are wrong. Even, Paul Tudor Jones has drawdowns. Sure. Everyone has drawdowns. So, when I was a young guy, and I, probably, we're in the same generation, I used to feel dumb if I didn't know. Now it's wisdom to admit you don't know instead of trying to force an opinion. Do you have an opinion on gold?
Yes, I have a strong opinion on gold. And let me just say, I have been an investor in gold since '94.
Yeah.
And have, a great deal of my assets tied to gold in one form or another.
Miners.
So that's all ways and shapes.
Yeah.
But let me just say that here, I'm a student, so in this case, I'm going to say some things that are not in the mainstream at all. People just don't understand. I'm going to give you some concrete evidence to support my case. But you see, gold is a relative inflation hedge to other things. The best inflation hedge are stocks. Why? Because they pay a dividend and because they can raise prices. As you witnessed last year, the great earnings they had, raising prices. So most institutional investors and most investors will go with stocks as long as they're making money. That's the key concept right there. Now, what should happen, and why gold, which by the way is highly negatively correlated to stocks, as I'm sure all your listeners know. So the key is that gold will go up when stocks are going up with one contingent, when rates are rising. So gold is going to go up when the Fed actually does increase rates a quarter or so. Now, if any of you want to doubt this logic, go to 1977, pull up a Bloomberg chart on stocks, which went down for 11 months in a row without a 5% rally. And gold went straight up as soon as stocks came down. And there was inflation accelerating. As a matter of fact, the Fed funds rate went from 5.5 to 19
that was Volcker.
So I'm even before Volcker, he came in November of '79, but before that, Fed funds were moving up steadily. That didn't stop inflation. Why? Because the Fed was printing more money. Let's say you're a manufacturer and you're making 20% a year, and the Fed is pouring money into the system, and they raise rates a quarter. Do you care? No. Are you going to stop production? You only stop production when the money supply is curbed and you can't borrow money. Then your inventory is screwed. Then you got to liquidate. So,
is there any difference, though, Vic, between the 70s and now, just based upon the size and magnitude of debt structures and participation in financial markets? I know that cycles don't repeat, they rhyme, and this reminds me a lot of the 70s. But, could it be that, that was like a 10-story building, and now we're talking about one of the tallest buildings, market structures ever built?
Yeah, but the key here is that, and Milton Friedman proves this for hundreds of years, it's always the money supply versus the goods and services being produced that creates inflation. So it's the money supply expansion. Yes, demand will be curbed when you raise rates to a degree, but the proportionality is to what degree? If you're pouring, I mean, M2 was increasing from January of 2019 to date at a 15% plus rate, and M1 was increasing at 77%. You see, so you're going to get inflation. If you don't curb the money supply, you're going to get inflation, period. There's no way around that. And, if you give me your email, I'll send you, this goes back to the late 70s when Milton Friedman made a speech. He proves this with about 7 different countries, and he shows the correlation between inflation and money supply is literally 99. And it basically is in any country at any time. So it's 2 and 2. You print more money and you don't produce more goods, prices rise. It's that simple.
Okay, well, while it was being announced that you were going to be here and I was going to have a chance to talk to you, I got some action on Twitter. And one of the questions are, people want me to ask you about your endgame insight and forecasts and how you think this whole thing is going to play out over the next couple of years. Can you give us the cliff notes of that in about 8 minutes, 10 minutes?
Yeah, sure. It's pretty easy because I thought about this. First of all, you got Stephanie Kelton, MMT, Modern Monetary Theory. She's all over the Democratic platform when they were writing their policies. And you can see that. That's why they want to spend trillions. And, they basically, she's got them convinced. She's given a politician an answer to how he can spend more money and get away with it from from her opinion. But the point is, you're going to get this crash that Jeremy talked about, and it's going to come when it's least expected. But the end game, how we get out of 30 trillion in debt, and by the way, you're not counting off balance sheet debt. Last I looked, it was over 10 trillion. That's off, but they don't show that. That's the post office debt and other weird debt, like even student loans. The key here is people don't like chronic pain. They can withstand short-term pain, and then if it eases, they get happier. Now, with that thesis, now again, everything is relative. It's how long is short-term pain. But if you want to get rid of the debt, which is really what everybody talks about, but has no meaning because nobody acts on it, is with hyperinflation. So if, for example, you hyperinflate, the definition is 50% in a month. That's what the definition is. That's an academic definition by Phil Kagan. And you basically, in 4 months, a 50% CPI increase, the 30 trillion would go down by 94%.
Wow.
So then you start over. So it's a 4-month deal. So you can't go through a depression. That was, some say 4 years. It went longer into World War II. But the point is, 4 months. Now, it's a horrible scenario. Believe me, I've studied hyperinflations. It's not a good thing. Marie Antoinette learned the hard way. That was the first hyperinflation.
So did the Germans. So did the Germans. So, you know, I was thinking that maybe like last round, it was the Germans had hyperinflation and we had deflation. And perhaps this time we have the hyperinflation and they deflate.
Well, that's the way it's headed in my book. Now,
so a weak dollar is a part of your scenario, and that would help fuel the inflation. Look, we have inflation while the dollar has been steady for a year, right, Vic? So isn't a weak dollar only going to add gasoline to the fire?
Well, that's where you get the hyperinflation. It's a run from the money.
Okay.
So I mean, effectively, the dollar declining in a material way is what's going to cause hyperinflation.
Okay. So, you know, we're close, you know, may have started this week. You know, a lot of people are saying, you know, we made new highs for move. We've shaken out a lot of Euro bulls last week on the Fed. Dollar made new recovery highs, Euro down towards that 111 level. So I guess what you would advise people to do is diversify in their fiat and own hard assets and stocks on sharp declines. Are they going to close the market down during this? What's going to happen to, say, equities? Go ahead.
I'll say it this way. The worst scenario, if you ask 10 economists, would be a depression. Okay, so you say, what's the worst scenario economically you can have? They say depression. In my world, the worst scenario you could have is high inflation and recession depression. That would be the worst.
Kind of
the Fed is in a box, as everybody, you know, relates to it. If they do raise rates, because of recession, the Democrats will lose power for 20 years. So they're not going to. They don't want to cause a recession. They just want to talk the market down to stop the inflation expectations. But they don't want a recession. But if you do 4 rate increases, you're going to drive the market down, and you're going to cause a recession.
Well, I know a lot of guys that say they're going to tighten. They are going to go ahead, and then when everything comes apart, you know, it used to be in our day, wasn't it 2 steps and a stumble? Remember that? Okay, yes. So you know, the stumble would be them coming in with bazookas that made the COVID response look like amateur hour. And that's when we get the hyperinflation, is after we have some type of bust in the market and they come out with bazookas that are much bigger.
Correct. And that also would cause, as you talk of raising rates up to 7 times in a year is what Chase said. I mean, you get people buying the dollar to basically get a higher yield, and they basically get the stability of the dollar as long as that occurs. Now, if there's bad economic news, I mean, this was relatively good because it was 150,000 projected payroll increase. Yeah. And there was even talk of 400,000 minus. Like I said, it can be any number.
Like the ADP this week.
That's right. And it can be any number because they seasonally adjust these numbers. So next month, they'll reduce it a little bit to smooth the numbers to what they think employment will be for the year. And they average it out monthly and they just adjust the numbers. But the key is that if you see bad economic news, that's when you're going to see the dollar weaken, and you know, good news is bad news in this case for if you're short the dollar. But the key is it's gonna go the other way because the economy is slowing and there's no more build back better in the coming up in the stream of spending. You're going to slow down, and basically, the Fed is never going to.
Well, here's my, here's my back up the truck level in gold, 1730 to 20ish if we get there in the next month, and silver maybe around 19. So I know you're a metalhead. I'm not talking Metallica. Do you think the gold silver ratio, Vic, is going to? You remember when the mean used to be about 40? You know, and we peaked up above 100. Do you think silver will outperform during this that period that you're talking about over gold?
Yes, because if more people will run to silver,
Poor man's gold.
it's poor me. It's like the stock split in Google. You know what I mean? They lower it because people buy lower prices. They get round numbers and they like that.
They could have a bigger stack than just having 10 Krugerrands somewhere, you know? Vic, so I want to ask you something about your website. Do you have any kind of business model? Why are you, you know, out there in the public? Are you looking to gather subscriptions or, you know, the purpose of your website?
Generally, we do institutional business. And what I do is I build trading algorithms.
That's right. I saw that.
These various commodity indices, which S&P branded them. Now that we took them back, so we have them back. But I build these models depending on the needs of the customer. It's generally institutional. It's generally with mutual funds. We had one listed with Wisdom Tree, the DTI, which basic diversified trends indicator. What happens is with all of these deals I do with people that once they pay the fees, and you know we have license fees for this stuff, they try to do it themselves. They usually blow themselves up. We have this with Rotex. We have Wisdom Trees. What they have today that trades is nothing like what they used to have, and it's a poor performer if you look at the data. But the point is, I build these things for certain purposes, and I custom it. And that's what we still do today.
Well, thanks for addressing the retail community today, Vic. I really glad that our paths finally crossed after following you for many years. What's your favorite book, Vic? You wrote them all. What's your favorite book, and which was the bestseller?
Well,
they're all your favorite.
Going back to you know so many years when I first started to read books. Dow Theory was one of my biggest moneymakers, believe it or not, by Robert Ray.
Okay.
And I read many of Gartley's books on technical analysis. I mean, these were excellent books. Of course, the stock speculator or reminiscence of a stock speculator. I mean, there are these classics. I don't have anything today that I could recommend, but that's me because I haven't been, I've been reading the new stuff. I've read maybe 3,000 books, and I'm very, very happy with what I've learned in the old books. Markets evolve and they change, and rules change. And for example, this is not something well known, but in 2011, when the Fed started to pay interest on reserves, if you go back to that period, now that didn't strike me, to be fair. I didn't get that originally, but hats off to the PhD that came up with that, because what they basically did was pay the banks not to loan money. So you got very low relative rates of inflation. Money supply was under 6. The M2 grew at under 6. You got inflation at as low as 164 on a 10-year basis, ending 17. You'd have to go back to 1955 to find a lower 10-year rate. And it's all because the banks took the money from the Fed. I mean, look, let's say you're borrowing at Fed funds rate when it was 2%. What are you going to loan to a prime customer? You're going to loan 3. Well, for that 1%, you'd rather take the 2.25 and bank at 100% and not have any reserves. There's no reserves when you do that. So I'm only saying that basically that rule change in 2011. Also, what's called hold to maturity accounts. What the banks do, they print money and buy from the government as well, but they didn't want the mark to market. So in 2014, they made them change the rules, and basically they have this thing called the hold to maturity account. No capital hits, no mark to market. They print the money, and there's no Basel III capital hits either. There's no reserves and no capital hits. I mean, it's an arbitrage. They arbitrage the interest.
So what's been happening in the Fed funds market with all the drains that were happening, and the Fed came in last fall and really started to.
That's a great question. And they got up to $2 trillion in the end of the year, or 19 odd. And that to me was when the Fed wanted to stop inflation, once it got to be a political event in the latter part of the year last year. What they did was reverse repos are a drain, right?
That's right.
So
They used to call them match sales.
right. Okay. Yeah, exactly.
Yeah.
So
Yeah.
You basically are holding that. So what the Fed is doing now is with their right hand, they're talking about their balance sheet and raising rates. But on the other hand, what you'll see is anything they do to tighten, they will reduce the amount of reverse repos. So it's offsetting. So it's a trick. I mean, they're just fooling most of the people most of the time.
All right. Well, Jekyll Island, a lot of things happened. I wouldn't go on a vacation there to Jekyll Island, which is where it was formed. So, they're taking profits, Vic. They're a private institution. They're booking some profits from their longs for the last 10 years, right? So, really, isn't that possible? I mean, they want to make money too. The Fed wants to make money. So,
Exactly.
and all the Fed governors, can you ever believe, and I want to wrap it up with this, would you have ever believed that Fed governors were trading before Fed meetings and having positions? And I know it goes all the way through the Congress too. The Fed then talking about transitory inflation, and now they're tightening. Are we moving towards an era where the Fed is, about to lose control and credibility completely?
Absolutely. And I mean, the whole.
They're going to dissolve it in the new era?
That institution is so ingrained. I don't know about that. I haven't thought about that.
All right.
But all I can say is everything is being corrupted. And certainly, I mean, just to make the case in point, when Powell was asked by one of the reporters, I think it was Bloomberg, if he had the dates of the trades, and he said no.
Yeah.
Listen, I'm a compliance officer for my firm. If I make one trade ahead of my indexes, I mean,
we'd be in jail. We'd be in jail for this.
My compliance officer and my legal department come down on me like, give me a break. He doesn't know the dates. Of course he knows the dates. He just doesn't want to embarrass himself more than he's already embarrassed.
Yeah. Well, I was proud to have you on today, Vic. I really appreciate your time today, and hope that we could do it again. And everyone should follow you at Vic Sperando on Twitter, and check out Vic's website. I see some great content on here, victorsperando.com. And, you survived an interview with me, but I knew you were tough. And now you're my trading warrior brother.
Well, anytime they'll just reach out to me. You've got my cell number, I think. If not, just let me know and I'll send it to you. And I'm always happy to comment if I can. My strong point, because currencies are relatively stable, not in your world, but in my world. I don't have strong opinions either way on that, but occasionally I do. And I know it's going to happen in the end, but you can call me anytime.
Thank you so much, Vic. Really appreciate you being here. And thank you, everyone. Hope you enjoyed, Vic. Getting some comments. A lot of people will watch this video. And I just want to end the week with, don't just count your pips, count your blessings. Thank you, Vic, and look forward to talking to you down the line.
Thank you. Same here. And thank you for the interview.
All right. So that's a wrap, everyone. You could join the team in 7 minutes for the morning edge. Have a great weekend. Use the time the markets are closed, except for crypto, to come up with your plan. And I'll see everyone Monday. Adios and good hunting. Thank you, Victor Sperando.
My pleasure. Thank you.